Imagine waking up tomorrow and finding that nearly half of everything you've invested has disappeared. The news says the economy is collapsing. Millions of investors rush to sell. But at that exact moment, some of the world's greatest investors start buying. Because history has revealed a pattern that almost nobody sees. Every bear market destroys wealth for millions. But it also creates a new generation of millionaires. The question is, why? I'm Gavin. If you enjoy documentaries that uncover the hidden truths behind money and investing, consider liking the video and subscribing. By the end of this video, you'll understand why history's greatest investors actually welcome bear markets, and how the next market crash could become either your biggest financial mistake or your greatest opportunity. Let's start with a simple question. What exactly is a bear market? Because the answer isn't what most investors think. What exactly is a bear market? October. The world watched as one of America's oldest investment banks, Lehman Brothers, filed for bankruptcy. Almost overnight. Wall Street was thrown into chaos. Television networks interrupted their regular programming. Financial experts warned that the entire banking system could collapse. Across America, people logged into their retirement accounts, only to watch years of savings disappear in a matter of weeks. For millions of investors, it didn't feel like a temporary setback. It felt like the end. And that's exactly what makes bear markets so dangerous. Not because they destroy confidence, but because they convince ordinary people that this time is different. Yet history tells a completely different story, because what happened in 2008 had happened before, and it would happen again. So, what exactly is a bear market? Most people think it's simply a stock market crash. It isn't. A market correction is usually the market taking a breath. Prices fall around 10% after rising too far, too fast. Painful, sometimes. Unusual, not at all. A market crash is different. It's sudden, violent, often driven by panic. Think about Black Monday in October 1987. In just one trading day, the Dow Jones Industrial Average lost more than 22% of its value, one of the worst single-day declines in American market history. A bear market is something else entirely. It isn't one terrible day. It's an entire season of fear. Officially, a bear market begins when a major market index falls 20% or more from its most recent high. Unlike a crash, it usually unfolds over months, as optimism slowly turns into uncertainty, and uncertainty turns into fear. Then there's the word recession. Many people think a recession and a bear market are the same thing. They're not. A recession describes what's happening in the economy. A bear market describes what's happening in financial markets. Sometimes they happen together, sometimes they don't. And a depression is something even more severe. A prolonged economic collapse that can last for years. Thankfully, history shows those are extremely rare. Here's the surprising part. Since 1928, the United States has experienced roughly 25 to 27 bear markets. On average, they've lasted around 9 to 10 months, and the average decline has been approximately 35%. Those numbers sound frightening, until you notice one extraordinary pattern. Every single bear market eventually ended. Every one. Some recoveries took months, others took years. But despite wars, financial crises, pandemics, inflation, and political uncertainty, markets eventually recovered and continued reaching new highs over the long run. So here's the real mystery. If bear markets are a normal part of investing, if history has repeated this cycle for nearly a century, why does every generation become convinced this time it's different? Because the biggest losses during a bear market don't begin on Wall Street. They begin inside the human mind. Why smart people make terrible decisions during bear markets. A bear market doesn't begin with panic. It begins with uncertainty. Then uncertainty becomes fear, and fear changes the way we think. If bear markets have happened dozens of times, if history shows they've always eventually recovered, then why do millions of intelligent people still panic every single time? Because your biggest opponent during a bear market isn't the market. It's your own brain. Long before humans built stock exchanges, Our ancestors lived in a world where making one wrong decision could mean death. Imagine you're walking alone through a forest. Suddenly, you hear something moving in the bushes. You have two choices: ignore it or run. If you run away, and it's only the wind, you've lost a few seconds. But if you ignore it, and it's a predator, you lose everything. Over thousands of years, our brains evolved to prioritize survival over accuracy. That instinct kept our ancestors alive. But today, the same instinct often works against investors, because your brain doesn't know the difference between a tiger and a portfolio that's down 30%. It reacts to both as if you're in immediate danger. That's why bear markets feel so overwhelming. You're not just watching numbers fall, your brain believes you're losing security, your future, even your identity. Behavioral economists Daniel Kahneman and Amos Tversky spent decades studying this phenomenon. What they discovered transformed modern economics. People don't experience gains and losses equally. The pain of losing money is roughly twice as powerful as the pleasure of making the same amount. Think about that. If someone gave you $10,000 today, you'd probably be happy. But if you lost $10,000 tomorrow, you'd likely remember that pain far longer. Now imagine watching your retirement account fall by 30 or 40%. Suddenly, selling doesn't feel irrational. It feels like relief. Not because it's the best financial decision, but because your brain wants the pain to stop, and that's only the first trap. The second trap is even more powerful. Imagine you're standing in a crowded theater. Someone suddenly shouts, "Fire!" What do most people do? They don't stop to investigate. They don't carefully gather evidence. They look around. Everyone else is running, so they run too. Financial markets behave in much the same way. When prices begin falling, people don't just watch the market. They watch each other. Friends start selling. Coworkers start selling. Financial news becomes more alarming by the hour. Social media fills with predictions of another economic disaster. Eventually, selling starts to feel like the only sensible choice. Not because you've analyzed the facts, but because everyone around you appears convinced. Psychologists call this herd mentality. Then something even more subtle happens. Your brain begins searching for evidence that confirms your fear. Every negative headline, every recession warning, every market prediction feels like proof that selling is the right decision. That's known as confirmation bias. At the same time, another bias quietly takes over. Recency bias. When markets have been falling for months, your brain starts believing they'll fall forever. It forgets that every bear market in history eventually came to an end, because recent experiences always feel more important than distant history. And then there's availability bias. When every news channel is showing crashing markets, those dramatic images become the easiest memories to access. Your brain mistakes what's most vivid for what's most likely. That's why during every major bear market, people begin believing the future will look exactly like the present. By now, you might have noticed something. Almost none of these mistakes have anything to do with finance. They're simply part of being human, which explains why bear markets don't separate smart investors from everyone else. They separate emotional decisions from disciplined ones. Because while millions of investors are reacting to fear, a much smaller group is reacting to something else entirely: value. And that simple difference in perspective has quietly created some of history's greatest fortunes. The secret. Most investors never understand. Imagine you own a small business. Every morning, customers walk through the door. Sales are steady. Your employees show up for work. Nothing about your business has changed. Then one afternoon, a stranger knocks on your door. He says, "Yesterday I would have paid $1 million for your business. Today, I'll only pay $600,000. Would you suddenly believe your business had become worthless? Of course not, because you know something the buyer doesn't. You know what your business is actually worth. Now here's the strange part. People think rationally when they own a business, but emotionally when they own stocks. During a bear market, the exact same thing happens. A great company doesn't suddenly stop making products. It doesn't lose all of its customers overnight. It doesn't forget how to generate profits. Yet its stock price can fall 30%, 40%, sometimes even 60%. Not because the business has changed, but because millions of investors have. That's the difference between price and value. Price is simply what someone is willing to pay today. Value is what the business is actually worth over the long term. Legendary investor Benjamin Graham built his entire investing philosophy around that idea. He believed the stock market behaves like an emotional business partner. Some days, that partner is wildly optimistic. Other days, he's overwhelmed by fear. Your job isn't to follow those emotions. Your job is to take advantage of them. Warren Buffett learned that lesson early in his career, and he never forgot it. He once said, "Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down." Think about how we shop in everyday life. When your favorite store announces a 50% sale, people rush inside. They don't wait for prices to go back up. Yet the stock market creates the opposite reaction. When great businesses become cheaper, millions of investors rush to the exit. Why? Because fear convinces them that a lower price automatically means higher risk. Great investors see something different. They understand that temporary fear can push the price of a business far below its long-term value. That's why bear markets often become one of the greatest wealth transfers in history. Not because wealth disappears, but because ownership changes hands. The fearful sell, the patient buy. Years later, when confidence returns, those patient investors own a larger share of businesses that never stopped creating value. Not every company whose stock falls is a great investment. Some businesses genuinely deserve to fail. That's why successful investors don't buy companies simply because they're cheap. They look for strong businesses, selling at attractive prices. Benjamin Graham called this a margin of safety, buying with enough room for uncertainty, rather than hoping everything goes perfectly. And that's why bear markets create millionaires, not because crashes are magical, and not because great investors can predict the future, but because fear temporarily disconnects price from value. The crowd sees falling prices. Great investors see discounted ownership. The crowd asks, "How much could I lose?" Great investors ask, "What is this business really worth?" And for nearly a century, that simple difference in thinking has created extraordinary wealth. History never repeats, but investors do. Every generation believes they're living through the worst market crash in history, and every generation believes this time is different. The headlines change, the causes change, but the fear always feels the same. Take 1929. The Roaring Twenties had convinced Americans that the stock market could only move in one direction, up. People borrowed money to buy stocks. Optimism turned into greed, and greed created one of the biggest financial bubbles in history. When it finally burst, banks failed. Businesses collapsed. Millions lost their jobs. The Great Depression followed. To those living through it, the idea that the market would ever recover seemed almost impossible. Fast forward to 2008. The headlines were different, but the emotions were identical. This time. The crisis began with risky mortgages and a collapsing housing market. Lehman Brothers failed. Credit markets froze. Wall Street was in panic. Across America, families watched years of retirement savings disappear in a matter of months. Once again, people asked the same question. Is this the end? It wasn't. Then came 2020. This crisis wasn't caused by banks or speculation. It was caused by a global pandemic. Cities shut down. Flights stopped. Businesses closed. The stock market entered one of the fastest bear markets in modern history. For a moment, it felt as though the entire world had stopped. Yet something remarkable happened. Long before everyday life returned to normal, the market had already begun recovering. 3 different crises, 3 different causes, one identical pattern: confidence, greed, shock, fear, panic, recovery. That's why legendary investor Sir John Templeton warned that the four most dangerous words in investing are, "This time it's different," because history doesn't repeat itself exactly. But human behavior often does. People panic. They sell. They believe recovery is impossible. And then, the world slowly moves forward. Businesses adapt. Innovation continues. Markets recover. That's been true through wars, financial crises, pandemics, and recessions. Which raises an interesting question. If history has been giving investors the same lesson for nearly a century, why do only a handful of people seem ready when the next bear market arrives? While everyone else was selling, he was buying. September 2008. Wall Street wasn't asking, "How much lower can stocks go?" The question had become, "Will the financial system survive?" Lehman Brothers was gone. Banks were collapsing. Every news channel carried the same message. Fear wasn't just spreading through the stock market, it was spreading through the entire country. Millions of investors did the only thing that felt safe. They sold, but hundreds of miles away. In Omaha, Nebraska, one man was reading the exact same headlines and reaching a completely different conclusion. That man was Warren Buffett. While millions of investors were trying to escape the market, Buffett was asking a very different question. Which businesses are suddenly selling for less than they're really worth? That question changed everything. At a time when most investors refused to touch financial stocks, Berkshire Hathaway invested $5 billion in Goldman Sachs. Not long after, it invested billions more in Bank of America. To many people, those investments looked reckless. Today, they're remembered as some of the most successful investments of the financial crisis. But Buffett wasn't fearless. He simply saw the market differently. Because decades earlier, his mentor had taught him one lesson that shaped his entire career. Benjamin Graham believed the stock market behaves like an emotional business partner. Some days, he's wildly optimistic. Other days, he's consumed by fear. Your job isn't to follow his emotions. Your job is to take advantage of them. That simple philosophy became the foundation of value investing. Buy outstanding businesses. When temporary fear pushes their prices below their true value. Buffett followed that principle long before 2008. In the 1960s, the salad oil scandal caused investors to flee American Express. The headlines suggested the company was finished. Buffett ignored the panic. He looked at the business instead. Customers were still using American Express. The brand was still trusted. The long-term value hadn't disappeared. Years later, that investment became one of the defining successes of his career. And Buffett wasn't the only investor who understood this. During World War II, Sir John Templeton bought shares in more than 100 deeply discounted companies while fear dominated global markets. Years later, that decision became one of the most famous contrarian investments in history. Decades later, investor Howard Marks reached the same conclusion. The greatest opportunities rarely appear when investors feel comfortable. They appear when uncertainty becomes so overwhelming that most people refuse to act. Different generations, different crises, different investment styles, yet they all discovered the same truth. Great fortunes aren't built because markets never fall. They're built because great businesses occasionally go on sale. That's why history's greatest investors never asked, "When will the market recover?" They asked something far more important. What is this business actually worth? One simple decision that changes everything. Imagine two investors. Both believe in the same company. Both invest $10,000. Both hold their investment for the next 20 years. But one investor buys during a market boom. The other buys during a bear market. Years later, the second investor ends up with significantly more wealth. Not because they found a better company, not because they were luckier, but because they paid a lower price. That's one of the simplest and most powerful ideas in investing. During a bear market, Fear pushes prices down far faster than the value of many great businesses. If a strong company is temporarily selling for less than it's truly worth, every dollar you invest buys a larger ownership stake, and when that business continues growing over the following years, those extra shares have more time to compound. That's why legendary investors care so much about something Benjamin Graham called the margin of safety. The bigger the gap between a company's value and the price you pay, the greater your potential reward, and the more protection you have if things don't go exactly as planned. This is also why many long-term investors continue investing even when markets are falling. Not because they know where the bottom is, but because lower prices allow them to buy more shares with the same amount of money. A strategy known as dollar cost averaging. In the end, the mathematics of investing isn't complicated. Buying a great business at a better price can dramatically change your long-term outcome. But if the idea is this simple, why do so few people actually do it? Because the biggest obstacle isn't mathematics, it's life. Why most people never benefit from bear markets? If bear markets create so many opportunities, why doesn't everyone become wealthy during them? The answer is simple. Because opportunity doesn't arrive when life is easy. It arrives when life feels uncertain. Think about what usually happens during a bear market. Companies begin laying off employees, families worry about paying their mortgage, their rent, or simply keeping enough money in the bank. At exactly the moment when great businesses become cheaper, millions of people no longer have extra cash to invest. Not because they lack discipline, but because they're focused on something more important, getting through the month. Then there's the media. During every major bear market, the headlines become darker by the day. Markets in free fall. The worst is yet to come. Is this another Great Depression? Fear spreads quickly. Because fear captures attention, and attention drives ratings. The result? People stop thinking about the next 20 years and start worrying about the next 24 hours. Then comes social pressure. Friends are selling. Coworkers are selling. Financial influencers are predicting even bigger crashes. When everyone around you is running, standing still feels almost impossible. History shows that many investors sell only after months of fear have worn them down. Unfortunately, that's often when long-term investors quietly begin buying. That's why the greatest investors don't prepare during bear markets. They prepare before them. They build emergency savings, avoid unnecessary debt, and keep enough flexibility to act when opportunity finally arrives. Because bear markets don't create discipline, they reveal it. And that's the difference between understanding history and actually using it. The next bear market is coming. Another bear market is coming. Not because the financial system is broken, not because the world is ending, but because that's what markets have always done. No one knows when it will happen. No one knows what will cause it. It could be a recession, a financial crisis, a war, a technological bubble, or something nobody sees coming. The headlines will be different, but history suggests human behavior won't be. Millions of investors will panic. Many will believe, this time it's different. Yet nearly a century of market history tells a different story. Every major bear market eventually came to an end. The businesses that continued creating value survived. The economy adapted, innovation continued, and markets recovered over the long run. That's why history's greatest investors never tried to predict every crash. They prepared for them because they understood one simple truth. Bear markets don't create wealth overnight. They create opportunities. And only those who stay disciplined are able to recognize them. So when the next bear market inevitably arrives, don't ask, how much have I lost? Ask, has the value of great businesses really changed, or has fear simply changed their price? That single question has separated emotional investors from disciplined investors for generations. Because in the end, bear markets don't create millionaires. They reveal them. If you enjoyed this documentary, don't forget to like the video and subscribe for more deep dives into money, investing, and the hidden patterns that shape financial history. Thanks for watching, and I'll see you in the next one.